Imagine you have a fresh $1,000 in your pocket. The way you deploy that money right now reveals your current financial mindset. The standard consumer path involves buying the newest piece of technology. This choice locks your capital into a device that begins to age immediately, losing nearly all its value within a single decade. The owner mindset takes that same $1,000 and ignores the hardware. Instead, they buy a piece of the corporation that manufactures the technology. 10 years later, the consumer's phone is worth virtually zero. Meanwhile, if that owner had bought shares in a high performer like Apple, their initial $1,000 would have grown to $13,000. A day job generates the cash to pay immediate bills. Owning the right assets generates the wealth that continues to grow even after you stop working. This divergence leads to an immediate hurdle: knowing which specific companies deserve that capital. A few decades ago, Sears was a global retail powerhouse. They dominated the market and appeared to be an invincible, safe harbor for any investor. Investors who held those shares today would have lost every cent. The company went to zero, destroying all the capital tied to its stock. Choosing individual stocks based on headlines or internet hype is gambling. Without institutional research, you are simply guessing which company will survive the next decade. The possibility of a company going bankrupt or the entire economy crashing paralyzes beginners. It forces them to time the market perfectly to avoid a disaster. Consider the case of Cousin Bunty. He is an investor who possesses the most catastrophic market timing imaginable. Bunty makes his first $10,000 investment in 1987. He buys in on the exact day before Black Monday, the worst single-day crash in stock market history. Years later, he invests another $20,000 at the absolute peak of the 2000 dot-com bubble, right before tech stocks plummeted by 75%. He repeats this mistake twice more, deploying his savings right before the 2008 housing collapse and the 2020 pandemic crash. Over his lifetime, Bunty invests a total of $100,000. Every single dollar entered the market at the worst possible macroeconomic peak. Despite this, because he never sold, Bunty's portfolio grew to over $500,000. Had he reinvested his quarterly dividends, that total would exceed $1 million today. Bunty's outcome demonstrates that long-term holding and refusing to panic sell can overpower the damage of even the most catastrophic market timing. Holding an asset forever only works if the business survives. A broad strategy must account for the fact that even giants like Sears can fail. Investors manage this risk using exchange-traded funds, or ETFs. These act as a basket, allowing you to own microscopic slices of hundreds of top-tier companies simultaneously. The fund is self-managing. When a company inside the basket begins to fail, the fund automatically ejects it and absorbs a stronger company to take place. Because most brokerages now offer fractional shares, a beginner can own a piece of the entire United States stock market for as little as $1. This transforms investing from a gamble on individual winners into a passive engine tied to the growth of the overall economy. Executing this strategy successfully requires a system called always be buying. You set up automated recurring investments on a fixed schedule. This keeps your capital moving into the market, regardless of political news or economic forecasts. Even with this system, market downturns are a statistical certainty. On average, the economy experiences at least one recession every decade. During these crashes, savvy investors look for poop, panic leading to overselling, which creates opportunity and eventual profit. Severe economic downturns provide a temporary, systemic discount on world-class assets. While trading provides short-term excitement, true investing involves the patient, systematic acquisition of long-term ownership. This framework requires individual due diligence. This material is presented for educational purposes and does not constitute financial advice. The final financial shift requires abandoning the habit of making other companies rich to instead step into the role of the owner.